Good afternoon and welcome to the IMAP Specialist Series on Investing in Disruption. This is the third and last session of three that we've had this week, and we're covering what role will the disruptors and disruptive technology play in portfolio management. My name is Rob De Silva. I am Head of Research at SQM Research. The technological revolution has advanced at an ever-increasing pace over the last few decades. It's brought with it a gigantic series. Oh, my apologies. I should cover some administrative matters first. Can we just advance the slide? Thanks. We have here just how to ask questions along the way. We're going to have a conversation. We really want people to ask questions. So you can see at the bottom of the screen, there's a little Q&A button. IMAP has some great other events happening in 2022, which we'll talk about later towards the end. Toby Potter will address those. Feel free to ask questions at any time along the way and join the conversation. So let me get back to my introduction then. Thank you. Okay, so the technological revolutions brought with it gigantic waves of creative destruction and the spectacular evolution of entire new industries and business models. The popular word that summarizes all this today is disruption. It touches all our lives in some way. Artificial intelligence, big data, social networks, crypto assets, these things and more are driving our future. And the world of investing and managing money is not immune to this. We're here today to talk to three experts about how disruption and disruptive technologies are affecting the business of portfolio management. They'll each make some introductory remarks, and we will then open it to discussion and questions. So, as I said, feel free to ask questions along the way. Allow me to introduce our panelists. We have Cameron Gleeson, who is a Senior Investment Specialist at BetaShares. Cameron's role is to support all distribution channels at BetaShares and work alongside the portfolio management team. Prior to joining the firm, Cameron was a portfolio manager at Macquarie Asset Management, involved in managing Macquarie's structured product offering. Cameron's other experience includes Bell Potter Capital, JP Morgan, and Deloitte Consulting. David Wanis, CIO and portfolio manager at Longwave Capital. David is the co-founder, chief investment officer, and managing director at Longwave Capital Partners. He also manages the Longwave Australian Small Companies Fund. Longwave Capital Partners was founded in 2018. Prior to founding Longwave, David was a portfolio manager for almost 15 years at Schroeder Investment Management in Sydney. Jerome Lander is CIO at WealthLander. He's a portfolio manager at Dynamic Asset, an investing service providing managed accounts for advisors. He is also Chief Investment Officer at WealthLander, a fund manager which manages a diversified alternative fund for wholesale investors. Last year, the fund he managed achieved a spectacular 21% net returns. Please welcome our panelists, and I'll invite Cameron to open up with his comments.
I think we're going to start with David, if that's okay, just to
My apologies. That's fine. Let's start with David.
All right. Thanks, Rob. Thanks for the intro. As many of you know, most investment managers choose either a quantitative or a fundamental process to select stocks and construct portfolios. But few managers look to combine both of those things. And in our view, that's not for reasons of rational first principles. It's often for reasons of their own experiences. Sometimes it's quite tribal, where fundamental managers only believe in fundamental analysis and systematic managers only believe in systematic analysis. But at Longwave, we use a combination of both fundamental and systematic techniques to make better investment decisions aligned to our quality philosophy. So we actually see a lot of unique benefits and insights at the combination of both fundamental and systematic. And so today, when we're talking about some of the uses of technology and AI and quantitative methods, we can also bring some perspective on how we map that to fundamental techniques as well. Because systematic models have many strengths, and we've sort of put a few of them on the slide here at the right-hand side. But really, they bring this unbiased and consistent application of models to the assessment of investment opportunities. But systematic models are often weak in ways that human experience can often improve. And so fundamental analysis captures the strength of judgment, experience, and insight. And at the moment, we use that for areas of the market that systematic models cannot yet capture. But given how much the world changes, systematic models may never be able to fully capture the investment opportunities that we see. So we've chosen to pursue this quantamental approach, combination of quantitative and fundamental, to invest in small caps. And we focus on small caps for a few reasons. Firstly, the potential returns are a lot higher than large caps in this part of the market. So if we're going to use this novel, what we think is a highly effective decision-making process, we believe we should go after the part of the market where we can get the most returns for doing that. Secondly, there still remains a lot of inefficiencies in the small cap markets relative to large caps on both the systematic and the fundamental side of our process. And the other thing we observe is that a lot of systematic models that have been designed for large cap markets and large global markets don't tend to translate well into small caps. So all of our systematic models are built from first principles and understanding how small caps are different and why systematic models may and may not work in that part of the market. The final thing to say about Longwave and how we're bringing innovation to funds management is recognizing that often in financial services, innovation brings with it more complexity and higher fees. And so we need to remember that at the core of what we're trying to achieve is superior long-term net returns for clients. And that's net of everything. That's net of turnover, taxes, management fees. And so some of the things that we're bringing as part of the way we've structured our fund are lower fees. So we have an 89 basis point flat fee structure, so no performance fees in small caps. But we've also structured that fee so that it will reduce over time. So as the fund grows in our unit trust, the fee reduces down to 75 basis points, again, with no performance fee over time. The models that we use are aligned with our long-term investment philosophy. So low turnover, lower trading costs, lower tax costs. And so it all is designed to capture the insight that we bring in our investment decision-making and translate more of that into the net investment returns to the client account. So that's how Longwave are sort of bringing that combination of systematic and fundamental approaches together. And as we go through the session today, I'm sure there's lots of questions and examples we can provide as to how that is put together into the portfolio. Thanks, Rob.
Thanks, David. Really appreciate those comments. Let's now go in the proper order to Cameron to talk through his discussion.
Thank you, Rob. So I'll touch on the use of AI and data in passive investing. BetaShares is obviously one of the leading Australian ETF providers, and talk a little bit about how we think about investing in thematics that leverage disruption. But I wanted to lead after David because I'd seen his slides, and there's a few points that I thought were really relevant there and things to draw on. I mean, particularly the point of David using analysis data and AI as really just part of the process rather than the entire investment process. That's very much where we see the advantages of artificial intelligence in particular in the real world outside of financial markets. So one of our thematic funds, the BetaShares Global Robotics and AI ETF, invests across that space, and that includes, for example, industrial robotics, and that's become a very interesting space. So industrial robotics is, in some senses, quite a mature market segment, but what we've recently seen is rapid improvements in the development of sensors, and then the collection of data and artificial intelligence that has allowed the development of what are known as cobots, a new generation of industrial robot, leveraging that technology, leveraging AI to provide a far wider range of use cases. And so we're seeing huge growth in that part of the market. So it's just sort of talking a little bit about how these technologies aren't necessarily the solution in themselves, but are in fact used by existing products and services, and how they can be leveraged, and where you see that sort of near exponential growth. Talking about financial markets, again, very interesting what David said. We do see broad use of artificial intelligence in algorithmic trading, in high frequency trading. This tends to be very much tailored towards a very short-term approach, looking at the advantages of computer in terms of recognizing a pattern and executing in a very timely manner where time is of the essence. And we would agree with, I think David had on the chart there, understanding a changing world. That's where we think that the human still has an advantage. They're able to use intellect, creativity to look for, the sort of paradigm shifts where there isn't a mean reversion, there isn't a pattern that's going to repeat. And that's where we think there's, a real advantage for humans in terms of what we describe as thematic investing. So we consider ourselves a leader in terms of thematic ETFs. We are passive by nature in terms of our approach to thematics, not active. We're not selecting stocks. Our approach in that space is to seek to hold pure play companies that are truly exposed to a theme. We're not trying to pick the winners within a particular theme, but really hold all companies within that theme. And just to talk a little bit about our business and the way that we do that, there are various approaches to try to identify the relevant group of pure play companies. The first of which is that we're able to access very detailed data in terms of revenue breakdowns of companies. So we can analyze companies based on a revenue breakdown and the revenue drivers. Another approach is to use humans, use an expert panel that has perhaps industry connections, is able to evaluate the competitive landscape and identify the key players. The third approach, which has actually started to become popular in indexing, has been the use of natural language processing, which is a form of artificial intelligence. This is, in some senses grown in uses by index providers and passive exposure providers. But I would suggest that in the examples I've seen to date, is not yet at the stage where it's an effective tool for defining a universe of stocks in a reliable way. So still some way to go there in terms of that particular technology, wide case uses. An example of one of our funds is Crypt, our BetaShares Crypto Innovators ETF. So that holds publicly listed companies that are exposed to, well, essentially providing what we call the picks and shovels of the crypto economy. And this is sort of a fund where there's that question as to how do you actually select those stocks. For that particular fund, the index provider is Bitwise Asset Management. They are a leading asset manager within the crypto space from the US, and they know that environment really well. So they're best placed to serve that need and to identify companies. So using a human in that case, rather than data, rather than AI. But obviously, each theme has a different dynamic, and you have to assess each one very differently. I'll leave it there, and I'm sure there'll be plenty of other areas of discussion that we can go into. But thank you.
Thanks, Cameron. Appreciate those comments. Let's turn over to Jerome to talk through the topic.
Yeah, thanks, guys. Thanks, Rob. So I've been tasked with sort of talking about, well, how do you think about this stuff as a diversified portfolio manager? Because I manage, diversified portfolios, whole of portfolios holistically. And, obviously this session's about AI change, crypto, and how do you incorporate these things into your approach. So it's good to take a step back for a second and just think, what's going on. Obviously, we've got most people in the market still using very traditional backward-looking approaches, strategic asset allocation, etc., to build portfolios, which are basically extrapolating the environment that we've been in. Fortunately for them, we've had a very persistent environment until recently of disinflation globally, and leveraging up to the point now where we've, arguably got a broad-based bubble in asset prices, or maybe not so arguably, entirely dependent upon, the continuing belief in easy monetary policies and fiscal policies, etc. The problem with all of that, of course, is we are at a pivotal time in history where things are changing, and 2022 may well be the year where monetary policy, fiscal policy isn't quite as strong as market participants expect, and inflation clearly already is a problem. And if inflation doesn't recede as sort of generally expected to sort of acceptable levels, the old way of building portfolios is not very well suited to that. The backward-looking approaches that people are using, the rush towards sort of passive investments and cheap investments, etc. That's very broadly used across the market, right? This is a very mainstream approach where people are looking over their shoulder and saying, what is everyone else doing? What has everyone done for the last 30 years? We'll just do the same thing, and maybe we'll do it more cheaply or whatever. And so you've seen this rush of money into sort of chasing that sort of approach and continuing with that, whereas a lot of fundamental managers, obviously, or value-oriented managers, or people who, active management's questioned, all the rest of it. So that's all changing now. And so it's a very pivotal time for people to really consider these issues around, well, how do you incorporate change into portfolios? Because we know, outside the little bubble that we're all in of managing financial wealth, the broader world is changing rapidly. So disruption is a big part of it, right? Computing is making a big difference, AI, etc. So what do we do about these things? Crypto's come along. Obviously, clients are very interested in it. Most advisors, etc., and portfolios really haven't got their head around it yet to understand how to incorporate it into portfolios. But we all know that when there's change, there's opportunity. And so a big focus of the fundamental investor, to the point that was made before by David, is that they can actually assess these changes and make sort of informed judgments on how do you actually, what do you do with them in a portfolio sense. So, stepping back in a different plane, a couple of years ago, I was, I think you've always got to ask yourself, what value add do you bring to people? How do you actually meet these challenges? If computers are good at doing things and getting better and better all the time, what role does a asset allocator or portfolio manager actually play to be useful? And I certainly thought you've got to stay away from those guys in part. You've got to think about everything you do, whether that can be replicated by a computer in a better way. And either adopt that approach in part, as we talked about, previously with David, or just avoid it altogether and focus on those areas of change and opportunity that humans are much better able to assess. So I've certainly had that thought. But funnily enough, the market arguably is not more efficient than it was before. We might have thought a few years ago it become more efficient, but it's actually not at all. And there's huge opportunity for investors to do extremely well, which is, in a wholesale sense, why, I've done over 20% returns for many years now, with single digit volatility and risk in the portfolios I've been managing in the wholesale space, because there's just such great opportunities for active management if you really know how to step up and do it. But look, so, AI, as I mentioned, look, a lot of investors obviously have had a negative experience of sort of these sorts of approaches, because often what we're exposed to in the broader sense, in the retail sense, that what most of you are probably used to seeing is managers who aren't the best in class. Often the best in class approaches in AI don't make it. They don't make it to being available to you. And therefore, if you're not best in class, it's a machine versus machine race, you don't win that race. You've been sold on a very attractive thematic, but not on something that actually delivers the goods over time. So there's some thoughts around AI. Now, in terms of crypto, digital assets and so forth, and there have been some good sessions on that earlier this week, which, obviously encourage people to listen to if they haven't had a chance to think about. We are seeing now some institutional investors in Australia actually adopt digital assets into their portfolio, and Rest has, which is not entirely surprising given their younger audience, the younger sort of client group. To a small degree, they've said we're going to put some of this in. But for us, it is actually an attractive opportunity set, because I'm a diversified asset portfolio manager. I'm interested in alternative return streams. I'm not a big believer in concentrated portfolios. That is, portfolios that entirely depend upon just equities to perform well. And there are diversification benefits in being in different asset classes, including digital assets. In particular, how I'm assessing it, how I'm sort of dealing with it today, as opposed to 2 years ago. I mean, 2 years ago, I was probably the first institutional investor in Australia to actually make an allocation to digital assets, which was a long allocation when Bitcoin was below $10,000, seeing that the opportunity there was quite strong for a long biased allocation. Today, I'm much more long short in my approach. I'm very attracted to the space because of the inefficiencies, but the risks are more two-sided because of the macro environment talked about before. So I think that the best way to play it is actually to take advantage of the market inefficiency in the space, because it is dominated by relatively by retail investors making a lot of behavioral mistakes and trading in kind of predictable ways, which we're able to take advantage of, I guess, to add value from. But the point also we heard from Cameron is they've started a fund of picks and shovels approach, equities that sort of leverage off the growth in the space to sort of play it that way without having direct allocations to crypto assets or digital assets. The way we're playing it is both ways. So we think it makes sense to have allocations to the protocols, etc., the attractive protocols and themselves at some points in time, and to be short a whole heap of crap that's in the space as well. But also there are opportunities to be exposed to things like the miners, which are trading incredibly cheaply if the prices just stay where they are in 2 years' time. So we see that as being an area of opportunity. In terms of, obviously, the other way to handle this and think about it is that you need to think about allocation sizes, because it's very important to note that digital assets are much more volatile than any other sort of portion of the portfolio typically, and therefore their sizing has to be addressed. The long-short approach does partly address that risk of excessive sort of volatility from the space, and obviously the funds I manage are really interested in having low volatility. So basically, that's one thing, one way of dealing with it. Another way, obviously, is to make sure the allocation sizes are modest and containable, because there is a wide range of outcomes given what's going on, and nothing is a certainty, notwithstanding the fact there are real opportunities in the space and there are absolutely real things going on. It's not all just one speculative bubble. There are real things happening under the surface and real brains being put to work doing very useful things. Part of these things will be very disruptive, most likely, to traditional companies and traditional financial service providers, possibly over time as well. So this is a space that you want to have people who are actually aware of what's going on and understand the risks and opportunities. It's not a space to just completely write off in a lazy way and say, oh, it's all bullshit, because it's not all bullshit. There's plenty of bullshit in the space, but there's also an element of real, and it's understanding that real that's very important.
Jerome, that's fantastic. Thank you. Crypto is a very interesting and hot topic. So I'm going to pick up on that theme and address a question to Cameron, but also to the whole group. Let me start with Cameron, because CRYP has been mentioned. How do you see that investment sitting alongside crypto in general? Is it a proxy for crypto? Is it a diversifier? Is it something else? How does that fit in the world?
Yeah, look, a great question. I mean, I think, and this does sort of touch on some of the things that Jerome said. We would suggest that exposure to any sort of crypto exposure really should be, appropriately sized. Like, clearly there's a lot of volatility in that market. In terms of this particular fund, so this is exposure to the equities, and there's a lot of things that I like about this. Firstly, we talked about inefficiencies. There is, a huge degree of pricing power that the leading names in the crypto space have, and so they have become very profitable companies. And Jerome mentioned, the attractive valuations that these stocks trade at. So from a long-term perspective, I think I see this as a sort of a long-term growth thematic that will, to some degree, lessen its degree of correlation to crypto assets. But in the short term, we see that it is highly correlated to crypto assets as a whole. Now, so I would suggest it is one way to play the crypto environment. Thinking just from my own viewpoint, I'm not heavily engaged in the crypto asset space itself. I'm comfortable holding Bitcoin. I'm comfortable holding Ethereum, but I'm not going to go beyond that. I'm not overly active I'm not active at all in any altcoins. And I mean, I think this is sort of part of the challenge. And the fact there's over 6,000 crypto assets means that a lot of them are going to die. They're going to be worth zero. But some of them may well even challenge Ethereum and potentially even Bitcoin at some point. And that is another attribute that investing in the companies in this space gives you, is that those miners, the exchanges, asset managers, even the real world banks that actually bank the crypto space, there's not many of them, they are leveraged to momentum across the crypto environment. So they're a natural hedge for holding individual digital assets if that digital asset was to be replaced by another.
Yeah. Let me ask you, to you, Cameron, and to David and Jerome around the future for crypto-backed ETFs. I know BetaShares have publicly stated they're preparing to launch Bitcoin and Ethereum, and it wouldn't surprise me if others, not just your firm, but other firms come down the track at some point now that ASIC has opened this field up. So let's start with Cameron and then David and Jerome in terms of how do you see the future of this kind of mini space, if you like, within the crypto world developing? What differences will it make to investors and what they do and professional investors? Again, for David and Jerome, you know, how do you see yourselves getting involved in these kind of assets going forward? So let's start with you, Cameron.
Yeah, look, I think it will make a huge difference to those that want exposure to that space, and that is a large portion of the investing population. If you think about the risks around investing in effectively an unregulated off-market exchange, so you have risk of loss of essentially the asset, risk of that exchange being hacked. Otherwise, some of your alternatives in terms of ensuring that you have, very robust storage of your digital assets, the costs for you, I talked about how profitable these companies are that operate in this space, the costs that you have to pay to ensure that you have security of your asset are high. What having a crypto-backed ETF provides is it provides a, institutional grade custodial relationship. And that's really the key point of differentiation. It's what ASIC have enforced in terms of their guidelines, that they want to ensure that the universe is limited to what are really deemed to be acceptable crypto assets, which really does limit the universe down to Ethereum and Bitcoin. There's various requirements on the, whether or not those digital assets are traded by institutions. Is there accurate price discovery? Is there an active futures market? So price discovery is key, and that's going to limit the range which people can invest in. But secondly, it's the strength of that custodial relationship. The approach that we are using is called cold storage, which essentially disconnects the private keys for the crypto assets held by the custodian from the internet. And there's a range of protections required around cybersecurity, around compensation schemes if there was to be loss of assets. So it's about that security, and that's what you get with a product issued under a PDS, traded on the ASX, as opposed to going through an off-market exchange.
Yeah. Okay. David, any comments?
Yeah, I mean, we're not in our mandate likely to invest or able to invest in a crypto ETF, but I do have some perspective that I think may be interesting for the session. And I can talk to it, but there's a slide in the deck called "How Early Do You Need to Be?" And so, one of the things that's interesting in this space, and it was interesting listening to the session on Monday about, the potential for Web 3.0, and we could repeat, the value creation that came from the internet, and this rush at the moment of we need to be in this and back the winners. We have, although we operate in quite a dynamic part of the market, in some ways we're quite conservative in how we then pick stocks. We tend to wait for some of the winners to emerge. So, in any new innovative area, there's tens or hundreds of companies trying to be that winner. We tend to stand back and wait until a lot of these uncertainties have been resolved, and then have more confidence. Because if we're talking about an innovation that's going to drive a structural trend for 25 years, how early do you really need to be? And that's what this chart is sort of showing. So what it's showing is since Windows 95 and Netscape IPO, they're in about the same month, August 95, Microsoft compounded 17% per annum between then and November this year, right? So you could have got in right at the beginning, or at Amazon's IPO, you would have compounded at 37%. But, sometimes you can wait. You can wait until many of those companies at that period of time weren't known to be the winner. They were very new. It was a very new space. And if you think about, Warren Buffett as an example, I mean, he bought Apple in 2016, 9 years after the iPhone launched. And he's compounded, this is the price return, but the total return, including dividends, is north of 45% per annum for the 5 years since then. He didn't buy Amazon until more than 20 years after it IPO'd, and has compounded, I mean, it was only 3 years ago, but 34% since then. And so we're not saying, wait 20 years before you get involved, but sometimes it's worth stepping back and looking at the number of opportunities you get as an investor to invest in a long-term structural trend. And if this is a long-term structural trend, crypto, disruption of financial services, Web3, then we're going to see it evolve, and we're going to see more of these uncertainties around custody and who the winners are, start to de-risk. So there's no doubt there'll be some higher returns for those, at the very early stages, but it's not to say there's not opportunities all throughout a structural growth period. And so for context, I just put at the bottom there, the Coinbase IPO, which may or may not be the same seminal moment as the Netscape IPO in 1995, it only happened this year. It was just a bit more than 6 months ago.
Yeah.
So, we think there's always lots of opportunities. Finding structural growth opportunities is terrific because you can hold and compound wealth at a very high rate. But our approach tends to be, let's wait until a few of these things are a bit more proven out. There's not necessarily a huge rush to be first in the door. Yeah,
you make a very good point there, David. I think there's from that, it feels like there's two particular key elements that require some skill and attention. The first one is identifying what these long-term structural themes actually are. There's lots of different fads that come and go. And if you can figure out what is something that's going to run and truly disrupt the world and run a theme for 25 or 30 years, that's the place to be. And importantly, in the early stages of any of these themes, and if you go back to the early stages of telephones and railroads and whatever it is, there's hundreds of players in those markets in the early stages. Only a few survive all the way through. So the second element is figuring out who are the long-term survivors in that game. It's easy to say Apple's a long-term survivor today. It wasn't as clear when they virtually went bankrupt after Steve Jobs in the early days. So it's easy to see the phenomenal returns that can be had, but it's what's hidden behind it is just the difficulty of unpicking that and making those judgments. So Jerome, do you want to pick up on that? And also how would you see the development of ETFs in this space from your own portfolio management perspective?
Look, I feel like I want to take up the rest of the session now, Rob, with all those comments and all the things I'd like to respond to. But look, my view is that there's a couple of different things in terms of your actual question about ETFs. I think, look, the reality is that most Australian investors and intermediaries are very lazy. So they like an easily accessible vehicle to get exposure to something and a simple story. And, obviously we've seen product providers who've done it phenomenally well from understanding that, and providing the market what they're looking for. That's not a focus for ours at WealthLander. We're interested in getting outstanding risk-adjusted returns. So we not just giving people some, making things easy or for ourselves or whatever. We're actually, we think that inefficient areas of the market provide huge opportunity for those people who are prepared to do the work, for fundamental investors, as we were talking about, who get in there for human judgment. And there are phenomenal opportunities, wealth creation opportunities for specialists in digital assets and many other areas, which we're not talking about today, obviously, many other specialist areas, which we choose to address by having a diversified approach among them, right? And so from an investor perspective, that's a much safer way of actually accessing these opportunities rather than taking a bet on whether something's going to work or not. To the point around, yes, the blue chip assets are Bitcoin and Ethereum at the moment, but we've done very well out of some other very small allocations to other things, because these investments can have very positively skewed outcomes if you get it right. So you can be taking almost an insurance type policy by very small weightings to assets which have phenomenal upside if you know what you're doing, and provide with very little risk, have substantive opportunities for alpha and value creation for your investors without altering the overall dynamics and within the context of quite a conservative fund. So and it's having this approach across many different assets, which gives you the possibility of actually achieving 20% returns with single-digit volatility, right? And small drawdowns, which is really what being an outcomes-based type approach. Now, it's obviously more difficult to access those specialist opportunities within sort of a retail format, but you're probably tending more towards these things about who are the structural winners. Are there plays on the space that might do well long term? And there've been some names and approaches and segments mentioned there that may be reasonable ways of accessing that. But in terms of custody, the custody assurance and so forth, we think investors should do the work to make sure that that's the case anyway with other investments, and that's not a reason to not bother. But as I mentioned before, this is why the market's so inefficient, because so few people are actually prepared to get in there and do the work. And if you are, or have people who are prepared to do it for you, that's the opportunity to really add value and do well. So it's a very this disruption and change is very, very exciting. The other point I'd make is that, look, when you look back to kind of Web 2 and whatever, and some of these companies that have made a lot of money over time, and disruption is always going on in the world, but disruption is happening much faster now. You don't always have the chance to wait to see what happens, because a lot of the value creation's already happened without you by the time things become obvious now, and you may miss out on some really good opportunity, or you will miss out on some really good opportunities. And it's a probability-based game. You don't have to get everything right. You need to get most things right, and you need to manage your risk well. And that's the beauty about investment, is that unlike having a patient who's going to live or die, you get to have the statistical probability behind you of actually, if you've got good judgment and you've got the ability to do the work and make informed judgments that are on average right, most of the time you manage to carry the losers. You don't have to avoid anything just because it's risky. You can actually manage that in the context of your portfolio sizing, etc. And so the last point I'd make there is that when I see common mistakes with other investors, what they're doing, they're often either all in or all out of some idea. Like, oh, I hate something, or they're very emotional effectively about it. Like, I don't like crypto because of whatever, or I love crypto because of something else. And those positions are, usually wrong, to be so extreme on it. There's risks and there's opportunities, and often it's best to have, some allocation to many different things. They have merit in the context of a diversified portfolio, and it's not the individual merit of the asset itself. It's its merit in the context of a broader portfolio, which adds so much. Diversification is the one free lunch in finance, so to speak. And if you really know how to diversify a portfolio, and sadly the industry doesn't, I would argue, they don't diversify the portfolio, and they're too dependent upon certain sources of risk, or just equity risk, or whatever, as opposed to diversifying across numerous sources of risk and numerous sources of opportunity, and actually managing to add value in so many different ways to get superior risk-adjusted returns. So, I think investors need to think about all of those things when they're building good portfolios.
Yeah, I think you've made some very good points, and just picking up on a couple of them. I hear what you're saying about, we talked earlier with David about the runway that might be 25 or 30 years. Maybe that runway isn't as long nowadays. Disruption is happening faster. Wealth is being created and destroyed by disruption at a faster pace. So again, it comes back to skill in not just figuring out what these themes are, but what that runway looks like and how quickly you have to get on board. And also, again, in identifying winners or long-term participants, it's not a bad strategy to not just rely on one or two that you might think, but to diversify across the board. In any burgeoning market that's starting up and has thousands of options and thousands of opportunities and a limitless kind of possibilities, etc. It's a good idea to cast your net wide to try and make sure that you catch some of those winners in the net. So what it feels like to me overall, we're seeing an environment which, you know, in the equity world, we have index investing and ETFs sitting alongside of active investing and you know, more active products and thematic investing as well that coexist quite happily. And I mean, I don't see any reason necessarily why that can't be true for crypto assets as well. Yeah, let me turn to a different topic. Let's talk about big data and artificial intelligence. And let's go through the group and ask, how does it impact the way you manage money and the opportunities that you see in the market? We'll start with Cameron and go to David and Jerome. I'm not picking you last every time on purpose, Jerome. We'll switch the order.
Yeah, look, I mean, I did touch a bit on this. So the majority of our funds are passively managed. There's a rules-based approach. And if I'm discussing thematic funds, often we're talking about the key point as to how you select that universe of stocks. Yeah. And you know, many years ago we had a limited number of index providers. You know, more recently, which effectively fintechs have come into this space, and their ability to use AI to identify companies is interesting. I mentioned that the use of natural language processing to select companies. I did say I'm somewhat critical of it as an approach for being. I have various thematics, such as you know, there's some lists like smart materials, which really is an area of the economy that includes the development of a lot of patents, and
yeah,
that can be used in identifying based on patent data. But outside of those spaces, I just haven't seen it.
Your audio is breaking up a bit, at least the way I'm hearing it.
Apologies. I'll make sure I'm closer to the microphone.
That's right.
I was just saying that I have seen very specific thematics where AI or natural language processing has been effective at identifying, you know, a group of what I describe as pure qualities. Yeah. But outside of that, and that's generally speaking companies that operate in a very patent-rich environment. That's a very, very good environment for using language processing.
Yeah.
I just have seen indexing where it can be solely relied on to construct an index.
Yeah. Thanks, Cameron. Let's switch to David, and same question, but let me ask a part B, which might be a little more uncomfortable. Do you see a time where AI takes your job fully? Like it might take a taxi driver's job or a truck driver's job?
Yeah, I mean, it's interesting. I'll start with the part B and we can come back to the part one, because the issue with markets is they're non-stationary, right? They're reflexive. And so, you know, if everyone knows that every machine is going to do X, then that gets factored in and that changes. So a lot of the other problems that the world's trying to solve with AI are more stationary problems, like driving. You know, once the variables are solved, the view is the road's not going to sort of, suddenly change and cars are flying unexpectedly, right? So, I think that markets will always adapt to what's being used. But in terms of, replacing our job, I mean, if you stand back and say, well, how do we use technology? We start with the outcome of saying, in any part of what we do, fundamental, systematic, different parts of the research process, we're pretty agnostic in looking at any technology that can help us improve the outcomes of decision making. So if there are parts of that process, like maybe parsing the content of an earnings call using natural language processing that can improve that, then we'll use it. In terms of what we do use, though, we have kept it relatively simple, and for a couple of reasons. One, it can be tempting when you have access to some of this technology to throw it at a problem and you find amazing correlations that worked in the past, but they have no linkages to real economic drivers. So we always start from first principles and say, what's the economic hypothesis of why this particular signal might work? How is it connected to the real world and what's happening? And the second issue comes, and this was picked up in the session on Wednesday, around black boxes that may generate, signals that are interesting, but as an investor, you can never understand on what basis was that particular stock chosen, or position size chosen, or the diversification chosen. So there's, at least in our model, where we're combining, insight plus systematic tools, we always like to understand on what basis is this systematic signal being recommended to us, and how can we combine it in the portfolio. So I think we can use more technology through time. It can help us make better decisions. It doesn't feel like, we're at risk of being replaced in the near term, but, maybe there is a general AI that someone comes up with, and we all, are out of a job. We'll see, but nothing we can see at the moment.
Before I turn over to Jerome, can I just remind the audience that you're free to ask questions. Please just click on that little Q&A button, ask whatever you like as we get into the sort of final leg of this chat. So Jerome, your thoughts?
Look, I think there's really some excellent points there, made by very interesting points for me as well, by David, that I'd agree with. I think that, we're not about to be replaced. People who are actually adding value aren't about to be replaced by machines, but an awful lot of other people are already, in a sense, being replaced by machines, and probably deservedly so, but perhaps should be replaced even more by machines, given the value creation they create is zero in the sort of financial system. And I'm thinking about some of my banks and things like that. So why don't we bash the banks while we're here, just to make something, what else can I do that's worthwhile in this session? Look, but obviously in the asset management industry and consulting industry and research industry as well, so let's recast a critical eye on ourselves and really ask, what are we doing? Can we be replaced by a machine, as I mentioned before? And I think people don't ask themselves that enough. And disruption in the financial services is relatively slow because of various factors we probably don't have time to go into. But as David mentioned, we're still having trouble working out how to drive a car autonomously, right? It's not that easy. And driving a car through the financial system is even harder because of those feedback loops and etc. And so it's not the natural place to go kind of looking in one sense. And if you do create a great machine, you're not likely to really share it with a lot of people because you can eat the lunch of a whole lot of other people. And we've seen that arguably through time from some fund managers who've done incredible returns for themselves and then cynically produced products which haven't done those returns for their investors because of capacity constraints and all the rest of it. And look, to David's point, when a great machine comes along, you don't really understand how the machine works. It's a black box, really. It doesn't mean that it can't create value, but the problem is a lot of the value creation is actually temporary in nature. So you just don't. It's really tricky to work out when the value creation stops. They can sell something, and obviously, if you don't understand how it works at all, then I actually find it quite difficult to invest in a lot of those things. So even if I think, I can see them, I see fund managers, who actually I think are actually creating value, but I've got no idea when it's going to stop. It's going to stop the day after I actually invest the money. I have trouble with that sort of assessment often. And there are statistical approaches you can sort of use to try and help you work out, well, it has stopped now. But without understanding, that's not my preferred approach. My preferred approach is more the mixed approach to assessing things in a multifactorial way to come to a more not looking for small inefficiencies or small value add. I'm looking for meaningful assessments. So that's kind of where I've got much more probability on my side. So that's one of the challenges with that space. But look, there's a lot of ways to skin a cat. And the last point I'd make is there's a lot of ways to skin a cat, or there's a lot of ways to manage money. And investors often focus too much on just the ways of managing money rather than the effectiveness of the implementation and the alignment of interest that exists with those. So I think it's often important to not be too biased towards one way of managing money. I mean, I've certainly learned that through research, and you would have, Rob, too. You know that there's many ways to manage money effectively, and people do manage using the same approach less or more effectively, depending upon the skill and the quality of their implementation. And so there's a lot in that. There's a lot of don't get caught up on the first stage. Look through all of them when you're assessing whether something's worthwhile or not.
We've had a couple of questions on crypto, so I might turn back to that theme very quickly. And I'll start with you, Jerome, and wrap artificial intelligence into it as well, both in crypto and equity investing. Picking winners is important, but picking losers is equally important to avoid, right? You don't want to step on a landmine because that's the end of the game for you. So, Jerome, two things. Can artificial intelligence help you in that process, specifically looking at crypto? And if it doesn't, what's the human-based methods? How do you pick, or what are the elements that define, a winner or a loser in the crypto space? And then, David, if you could address the same question, I'd appreciate that.
Well, look, to the question, it's really important. So, one of the approaches I use is by using probability. So you've got to look at a priori probabilities. And one of the problems with challenges with crypto is that, 3 years ago, I went to a crypto conference, and I can tell you in Australia, I didn't think any of it was real. I thought the whole bunch of it was just absolute bullshit. And so this is probably, there's thousands of different things out there. It's very easy to create something and sort of promote it. And there's a lot of punters in the space who are wanting to make 10,000% in a day and all this sort of stuff, who are prepared to try and play some sort of magical chairs. And don't really care about the nature of whether things are real or not. So, it's often very easy to work out that stuff's not real. As in, there's many methods to use, which again, we probably don't have time to go forward to, that are indicative of things being promotional schemes.
But when you say, sorry to interrupt, but when you say it's easy, it's because you've got 20 or 30 years experience in the financial markets. Not so easy for someone, who's just found out about it in the newspapers over the last few weeks or.
Well, absolutely, and I think it's a very complicated space, and I think if you're a retail investor expecting to go in there and make a fortune directly with limited knowledge, I think you're kidding yourself. The first thing is to realize, what do you want to have a punt on something? Are you gambling, or are you actually investing? So I would discourage people from sort of just thinking they're going to pick the next dodgy coin or something, because it probably is a dodgy coin that's going to behave like one as opposed to dodgy coin itself. So, we're not great believers in that sort of thing. There are lots of, look, we are in a speculative market environment, as I said before. So you've also got that against you when you're going to buy stuff like this. It's not the time to go and chase risk. Most portfolios are actually out there chasing risk more. We think it's the wrong thing to do because they're dissatisfied with cash returns, obviously in bonds, and central banks have pushed people out the risk spectrum. And part of the reason that's why these assets are all so expensively priced. But as I said, below that, there's actually real things happening. And there's obviously blue chip assets, known blue chip assets, which, Cameron mentioned before, Ethereum and Bitcoin are the known blue chip safer assets. So if you want to have a blind exposure to some crypto, it's most likely you're safer by having something like that. But the way we're approaching it is that it's not just thinking, long, do I just buy long some crypto asset? It's much more, geez, there's a lot of inefficiency in this space. There's crazy volatility, there's crazy movements, there's all sorts of uninformed investors populating the space, and there's room for real fundamental research to pick some good opportunities and to pick times to be long something versus short something else. So it's an ultimate act. It is a very attractive market for active investors.
But in terms of fundamental research now, you're not talking about balance sheets and P&L statements, etc. You're talking about what is the use case for this particular token or whatever the hell it is. It's created for a reason. What is that reason? And does that reason make sense? Does it actually provide something useful and therefore has some economic value? Would that be right to describe it that way?
That would be part of the assessment. Is there a genuine use case, or is this just a speculative asset, traded as a speculative asset? Is it other sort of surrounding environment around it very promotional in nature, or is it something that have been worked? Who are the technical team? Have they been investing for some time on it? What are its differences? Can you assess the quality of the protocol, versus other things? Is it real, or is it just a copycat thing? You know, who's involved? What are the people? What's their history like? You know, are they real people doing real things, or are they just scam artists? So you know, there's lots of indications of what's going on. There's adoption of the use case as well, Rob. I mean, there's obviously a use case which makes sense, but is it really being adopted by people and being used as a key measure as well? So there's numerous things like this which obviously help you for simple assessments, which help you form a likelihood of whether something could be real or not. And before you go and delve deeper into the specifics. But you know, when you have an high probability that things rubbish, you have to be quite skeptical when you're approaching the space.
Yeah, David.
So I was just going to add something just to feed into David. I mean, this does that. You know, you talked about the adoption there, and it almost does talk to the same scenario that we saw on David's slide with regard to at what point do you decide to actively pick someone like an Amazon or something like that. Getting to the point where you have conviction that something will fly is not dissimilar to thinking about stock picking in traditional equity markets.
Yeah. So we don't. I mean, as I mentioned before, we don't invest directly in the asset, but we're curious and interested, and have watched for a few years what's been going on. And what I struggle with, to be honest, is what these things are seems to have changed every year. It's something different, right? So is it a store of value? Is it, a decentralized payment mechanism? Is it about remittances to third world countries? Is it about owning content in a Web3 framework? And so every time we try and drill into what are the real use cases and where are they genuinely being used in a way that existing infrastructure and existing technologies fail, it sort of almost gets there, and we never can quite see the example. So there's lots of theories, and even listening to the session on Monday, where there were two experts talking about crypto and different coins and so on. There was a lot of uncertainty as to what it really is. Is it like some of the comments about how to value it? There's a religious element to it. There's dogma. It's a new theory of money. Like, there were lots of these components, and as an investor, almost like the first principles for us is, do we understand what we're investing in, right? And because this thing seems to change every couple of years as to what actually it is and what it does based on a theory, is it the currency of the metaverse is the latest thing, like it just, that's where we would again go back to that slide and say, we'll probably wait. It may be fantastic. It may change the world, but from what we see at the moment, it just doesn't have that foundation of what's actually going on here and how's it being used. We don't think if it's that fundamentally changing of the entire sort of global economy, you're going to be too late if you wait a couple of years to understand it more. Now, Jerome might be deeper in the weeds and trading long short these things, and that's fine. But sometimes as an investor, it's important to know what you won't do, and we won't do things we don't understand.
I think some of the comments you made could trigger another hour of conversation, and I'm sure Jerome has got a few comments around all of that. But
I've got one very quick comment, Rob. If
okay, it's got to be quick, man. We're almost out of time.
Yeah, just to address that. I mean, you are at an early stage of this ecosystem. So there's an element of venture capital investing, and there are obviously real use cases for things. So and what happens with venture capital investments is that people kind of have something useful and not really sure how it can be used best. So they try something, and then they've got a new technology, and they go, "This is great. Oh, I thought it would be useful like this, but as it turns out, I'm finding it's useful like this." So it pivots a bit. So there's an element of that going on with this space, and that's probably one way to think about it that helps you address that issue of, well, hang on, they seem to be changing the purpose of it all, because at early stages it's hard to tell sometimes. It's kind of useful, but there's so many potential use cases, which is the best one, and how it'll be adopted and all the rest of it. And so I think we're seeing an element of that. So it's important not to write it all off because of that.
Look, that's a very good point too. I think what that means is that, as in the world, the world of equities, etc., you've got early stage venture capital, you've got various stages along the way, you've got pre-IPO, IPO, further on, and as that progresses, there's a smaller universe, a bit more visibility, a bit more a bit more clarity around the future, and it's perfectly fine to decide, I'm going to be involved at this stage or the early stage or somewhere else, and use my skills to get the best out of the portfolios for our clients. So I think that can operate quite well. David, let me just ask you, coming back to disruption, and this will be the final question because we do need to close up. Focusing on smaller companies, often, those in looking at that, some of them should be disruptive if they're going to develop and grow over time. And B, the flip side of disruption is, the death and decline of traditional companies. So, how do you see those two in the way that you operate? Is it automatically that disruption is going to see the decline of certain companies or certain sectors? And do you look for disruption in your small cap investing?
Yeah, nothing's guaranteed or automatic. I mean, in small caps, probably 30 to 50% of the companies in our universe are different to what they were in any 3-year period, 3 years prior, right? So there's always this kind of renewal and new companies coming through. In the ASX 100, that's maybe 5 to 10%, right? So a much more stable group of companies. So in small caps, we see these companies, but I think the language is important too, right? We think of innovation, like companies who innovate, they have a purpose for a positive change. They may end up disrupting someone along the way, but building a business and solving a problem, and it's often a pain point or a problem you're going to solve. It can be quite dangerous in technology to say we have a tool, let's try and find where we can use it. And that was actually where Apple pivoted 25 years ago. So it's not about selling technology, it's about solving problems. So some of the best small companies galvanize a team of people around innovation and a problem they're solving. They don't say, let's go and kill Westpac, let's go and disrupt the bank. They say, let's go and find a better way to meet this unmet need through technology or a new business model or something else. So yes, we see it all the time in small caps. That continuous renewal in the space brings through new challenges, new innovators. Lots of them don't make it, but those that do, 10, 15, 20 years later, they end up in the ASX 100. They become the new crop of large caps. And the compounding wealth you can generate if you can identify and hold those is terrific. So yes, we're always on the lookout in this part of the market, but we think about it from the positive perspective. What are they trying to achieve, rather than this kind of negative view of disruption and let's go and kill other people or other companies. Yep. It tends to create the wrong incentives.
Yep. Thank you. It's time to close off the conversation. We could happily go on for another hour or two. I just wanted, before I hand over to Toby, thank Cameron from BetaShares, David from Longwave, and Jerome from WealthLander for a great discussion and lots of expert intellect. So thank you, guys, and I'll hand over to Toby.
Thanks very much, Rob. And on my behalf, IMAP's behalf, thank you for the work you've done. This has been one of the more challenging webinar series which we've run over the last week, precisely because, as David said, actually, it's changing a lot. We set out to bring a webinar series to our audience that focused on disruption. But then as we started to think through, well, what does that mean? Obviously, it took us down the Bitcoin path, and we've had both Monday and part of today talking about Bitcoin. And we spent Wednesday and part of today talking about artificial intelligence. But we've ignored huge areas of disruption that David touched on. We live in a dramatically changing market environment. And as investors, as Jerome touched on, it's part of our challenge to try and understand the way in which the markets in which we invest, the companies in which we invest in, the instruments that we invest in, are appropriate or not appropriate for the world that we're going to find ourselves in the next 6 months, in the next 12 months, in the next 5 years. As Bill Gates said, less happens in any 2-year period than you expect, but far more happens in a 10-year period than you can contemplate. So Rob, thank you for the work you've done today. Looking forward, as we touched on very briefly earlier on to 2022, and this is our last event for 2021, thank God. We've got our portfolio management conference where we'll draw out many of these issues again in Melbourne, Sydney, and Perth. The FPA Congress, which I'm sure many of you will attend, And then independent thought, which is a new opportunity for us to showcase the thinking that's going into the creation of managed account portfolios. We've been lucky in this week to have had Heath Benke from Polon, Craig Hobart from Monochrome, Dr. David Allen from Plato, Dr. James Yang from Coolabah Capital, as well as Dr. Jerome Lander today, David Wanis and Cameron Gleeson from BetaShares, to sort of start to address the way in which disruption works within managed account portfolios. For independent thought, it's an opportunity for us to really focus on the sort of thinking that's taking place at the licensee level, the way in which managed account portfolios are really being put together to address investor needs. So thank you for all your participation through this year. We all look forward to 2022 being a more normal year, and that we only get to the 15th letter of the Greek alphabet and not the 17th or 20th. So thanks very much for your attendance. To all of you, we wish you all a happy Christmas, a welcome break, and we look forward to seeing you all back here again in 2022. Thanks very much.
Thanks a lot, Toby.
Thanks, guys.
Thank you.
Thanks, everyone.
Thanks.